It's a very pleasant morning to everyone. Yes, I hope all of you are doing well. Yes, so in today's session, we will be discussing RTP questions on chapter number 17, chapter number 16, chapter number 17, and chapter number 18, right? I'm hoping all of you have gone through the recordings of these chapters. Okay, just to give a quick overview of all these chapters, chapter number 16, chapter number 17 and chapter number 18. Okay, chapter number 16 is basically on due diligence. There are three segments to this chapter. The first one is due diligence, the next one is investigation, and the third part is the third part is forensic audit, right? So due diligence, investigation, and the forensic audit. The chapter number 17 is peer review and quality review, and chapter number 18 is the professional ethics, right? Now, chapter number 16, due diligence, investigation, and the forensic audit. As such, if you go with that, sir, one question generally comes from this chapter, right? One question generally comes from this chapter. Chapter number 16, it's divided into three segments: due diligence, investigation, and the forensic audit. One question generally comes from this chapter. It would be not all the three segments will come. Any one question, right? It could be from due diligence, it could be from investigation, or it could be from a forensic audit. You can expect at least 4 to 6 marks from this particular chapter. Next one. Now, all these are short segments, so it's easier to score marks in this area if you have gone through these this particular chapter, right? Chapter number 17, on the other hand, is peer review and quality review. Again, it's a very short chapter, very nice chapter. It's easier to understand and easier to kind of score marks in this area. You can again expect one question from this chapter. You may get a question, you may not get a question. So this chapter is not like short. There will come a question will come. You may get a question, you may not get a question. Peer review and quality review is basically how ICAI, the Institute of Chartered Accountants of India, does what is the process it follows to do a peer review, what are the norms with respect to peer review, what are the norms with respect to quality review. That is what is discussed in this particular chapter. The chapter number 18, the most important and a very important chapter from an examination perspective, is your professional ethics. A very important chapter. You can expect around 10 to 15 marks from this particular chapter. In fact, the name of this entire paper is Advanced Auditing and Professional Ethics. The word professional ethics is coming from chapter number 18 of this particular subject, which is professional ethics. You have a complete download of the Chartered Accountants Act, right? And these specifically the misconducts, right? You have the schedules. Okay, you have first schedule and the second schedule. Each schedule has 4 parts, I mean, roughly, and there are multiple clauses. So you will have to go through all the clauses. You have to memorize all the clauses and write down the clauses as such, right? So that is the essence of this chapter. Apart from that, there are other things also, but this is the major crux of chapter number 18. A very important chapter. You cannot go into the exams without studying chapter number 18, professional ethics, right? That's a very important chapter, right? Having said that, let's start with the first RTP question in hand. Question number 1, RTP question number 1. Data Limited is anticipating taking over a manufacturing concern and appoints you for due diligence review. So the moment due diligence comes, it's chapter number 16, right? While reviewing, it requests you to look specifically for any hidden liabilities and overvalued assets. State in brief the major areas you would examine for hidden liabilities and overvalued assets. Right now, this is very simple, straightforward question. Okay, if you've gone through the recordings or if you've gone through your study material, this is a direct question, from the books. Okay, while reviewing, it requests you to look specifically for any hidden liabilities or overvalued assets. So there is a question in the ISM or in the study material that you're following with respect to hidden liabilities and overvalued assets. So there are certain points which are given in the book. You just have to reproduce those points and your answer is done, right? So that is the ask of this particular question. State in brief the major areas you would examine for hidden liabilities and overvalued assets. Right. So let's go with the answer. It's a straightforward question from the book. There's no, there's nothing to think or nothing. If you know the answer, you can write. If you don't know, you will not be able to write. Right. So major areas to examine in the course of due diligence. Now, first two paragraphs is basically an overall understanding of what a due diligence is, how it works, etc. And then we start with the answer. Due diligence is the term that is often heard in the corporate world these days in relation to corporate restructuring. The purpose of due diligence is to assist the purchaser or the investor in finding out all he can reasonably about the business he's acquiring or investing in prior to completion of transaction, including its critical success factors as well as its strengths and weaknesses. So basically, what is the due diligence? When one company wants to acquire another company, or when one entity wants to acquire another entity, right? So the acquiring entity will appoint a due diligence, will call for a due diligence generally, right? On due diligence on what's the due diligence on the seller entity, right? So to understand whether there are any risks, whether the business of the company, whether is proper, right? Whether there are any red flags with respect to the transaction itself. So I mean, I'm giving a particular, I'm going to pay say so much of money, right, to the shareholders of the seller entity. So now everything boils down to that. So if there are any issues which I am supposed to know prior to completion of the transaction, prior to making the payment for the share, I should know, right? And then I'll have to adjust the same while paying the money. I have to adjust the same with the purchase consideration. Yes or no? So that is what is the main purpose of due diligence. Now this is a typical example of a due diligence. That's called a financial due diligence. Okay, a buy side diligence. That could be in the sell side diligence also, right? Where the seller entity wants to sell itself, and it appoints a third party for conducting due diligence on its own. With that due diligence report, it can go to the potential buyers to and give this due diligence report, asking them to, boss, you please buy me out, right? So that is called a buy side or a sell side due diligence. So due diligence are of multiple nature, multiple types, right? Due diligence is an all pervasive exercise to review all important aspects like financial, legal. So it's not only a financial diligence. I mean, if you read the chapter, there are multiple types of due diligence. One is the financial diligence, a legal diligence, a commercial diligence, a tax diligence, right, and a HR diligence. Like there are multiple and different types of diligence. Okay, depending upon the need of the investor, and depending upon the industry, right? If it's an IT company that you are looking to buy, then you may have to do an HR due diligence, because HR, the employee costs and employees are of more importance in an IT company scenario, right? So HR diligence takes a lot of importance and takes a lot of precedence, right? As far as any hidden liabilities or overvalued assets are concerned, so why are we concerned about any hidden liabilities? Because tomorrow, if any liabilities, once I pay the money, right, I become the shareholder of the company. The buyer becomes the shareholder. The company is the buyer's baby, right? So the moment that happens, right, all liabilities, all assets, everything, the buyer is 100% responsible because he owns all the equity in the company, right? Now, if there are any hidden liabilities which I was not aware prior to the transaction, in that particular scenario, what happens if I'm not aware of that particular hidden liability? Right, I will have to pay the liability. I cannot again catch the collar of the seller. Okay, no, boss, you pay me. Right. So it is important for the buyer to do a due diligence to find out if there are any hidden liabilities or if there are any assets which are overvalued. Why? Because basis the valuation of the assets only, the purchase consideration is derived. So that is why there should not be any overvalued assets or there should not be any hidden liability. That is why due diligence is done, right? Okay, so as far as any hidden liabilities or overvalued assets are concerned, this shall form part of such a review of financial statements. Normally, in case of hidden liabilities and overvalued assets are not apparent from the books of accounts and financial statements. Of course, they are not apparent. You have to do a proper diligence and now diligence is very different from audit, right? Diligence is very customizable. It depends upon the requirement of the investor. Okay, audit is a very standard this thing. Okay, you have to follow these engagement and quality control standards, the standards on auditing, and you'll have to give a report. The report is also very uniform in structure. You know what you need to do. You know the purpose. It is for you to provide an opinion on the financial statement. Due diligence is not like that. Due diligence keeps differing from investor to investor. The need of the investor is very different. Every transaction is very different in its own way. So we'll have to understand what is the purpose of the transaction, what is the purpose of the due diligence, what is the purpose of the investor, why is he putting money in the company, what is the rationale of the transaction. Basis that the due diligence has to be done. Okay, so we'll have to meet the expectations of the investor. So that is why a due diligence is very much different from an audit. But the procedure that you perform in due diligence are similar to audit, like practically, right? Coming back, review of financial statement does not involve examination from the viewpoint of extraordinary item, analysis of significant deviations, etc. Now this is the main answer. This is what is the question, because the question stated, please tell us why reviewing it requests you to look specifically for any hidden liabilities and overvalued assets. State in brief the major areas you would examine for hidden assets and over liabilities, right? So it is asking where and all you will check for hidden liabilities and overvalued assets. So for that, this is the answer. The first two paragraphs are just just giving an introduction. You may wish to write, you may not wish to write. Okay. Now, for hidden liabilities, there are 1, 2, 3, 4, 5, 6, 7, 8, 9 points are 10 points are there. Okay. For overvalued assets, again there are 13 points for hidden liabilities. For overvalued assets, there are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 points. So how to kind of revise this, I mean, memorize these points. Okay, now these are points directly from the book. I mean, if you look at your study material or whatever material that you're using, it is directly from the book of accounts. I mean, book of in the ISM. It's not, so you will have to write these points only in the examination. You can write it on your own, but the relevant key points should be there. So in order to achieve that, you will have to kind of use a catchword, an acronym, okay, for you to remember these points. You understand what I'm saying? Only if you do that, you will be able to remember these points and you'll be able to write the answer, because these are very, very simple questions that are asked in the examination. If these questions come in the examination, you have to attend them, because these are very, very simple and straightforward points. Clear? Now, coming back. So first one, the company may not show any show cause notice which have not matured into demands as contingent liabilities. These may be material and important. The first one is show cause notice S. Okay, first one is the show cause notice S. Next one, the company may have given letters of comforts to banks and financial institutions. Since these are not guarantees, they may not be. We are talking about hidden liability. Hidden liability means that it will generally not be there in the books of account. No entry would have been passed, but the liability will still be there, which you will not know otherwise. Because how will you know? Only if the management tells you, you will know. Otherwise, you will not know. Correct, because all these are not there on the balance sheet or the financial statement. There's no entry pass for this. So show cause notice has come to you, but you may have not passed any provision or nothing. The management is silent about it. Therefore, it becomes very difficult for the diligence person who's doing due diligence to identify such hidden liabilities. The first classic example is issue of show cause notice, which only you will know when the management informs you. If the management does not inform you, then you will not be in a position to understand, right? The company may have given letters of comforts to banks and financial institutions. Since these are not guarantees, they will not be disclosed in the balance sheet of the target company. Letters of comfort meaning letters of guarantee. Basically, the company would have given a third-party guarantee, a guarantee to the bank that if suppose this party defaults, I will be paying it. So it's a contingent liability on the books of the company, though it will not be generally recorded in the books, right? The company may have sold some subsidiaries and businesses may have agreed to take over and indemnify all liabilities and contingent liabilities of the same prior to the date of transfer. These may not be reflected in the book. So again, a guarantee given, they may have sold some assets in the past, some entities in the past, for which they will still be held responsible. Now, tomorrow, if that particular subsidiary, there are some hidden liabilities in that sale, then who will be responsible? The company will be responsible. Now, who is the owner of the company post the transaction? The buyer becomes the owner, and therefore he will be held responsible, right? So these are all hidden liabilities. So a B stands for company may have sold some subsidiaries, SLB. Next, product and other liability claims, warranty claims, right? So this is the next one, W, warranty claims. Tax liabilities under direct and indirect tax laws, T, SLBWT. Next, long pending sales tax assessments, A, assessments. pending final assessments of customs duty where provisional assessment only has been completed. Sometimes what happens all the time, what happens, customs duty, the assessment does not happen on there are two types of assessment: provisional assessment and final assessment, right? Provisional assessment happens first, okay, where provisionally an amount has been decided and you have to pay the customs duty basis that, and then the final assessment happens at a very later point in time, right? So it could be as similar to a provisional assessment, or it could be a different from the final assessment could be very different from the provisional assessment. So therefore, there's always a liability involved. There may be a liability involved. Okay, agreement to buy back shares sold at the stated price. This could also be a potential liability. Future lease liability. So customs duty C, buyback B, and future lease liability L. And environmental problems, third-party claims, etc. So environmental problems could be E. Next, unfunded gratuity, gratuity or superannuation or leave salary liability, incorrect gratuity valuation. So this could be another liability, right? Huge labor claims and a negotiation. The labor wage agreement has already expired. So unfunded gratuity and labor claim. So this is roughly your catchword. Okay, this is your catchword. Now, basis this, you have to make these are the small. Now, I'm just explaining you how you need to kind of remember this in the examination, because that's very important for us, right? So the catchword which you can make is STABLE, stable. Okay, GLSCW, right? Stable. There are two A's, so you can STABLE, right? GL and CW here, C and W, right? So this is a catchword that you can probably make, and you can remember this in the account. Remember this while I'm just giving an example as to how you need to, because a lot of students keep telling me that I study now, I memorize, okay, but I am then not able to remember after a few days. So now memory is not like you remember forever. Yet you'll have to keep revising it, but we don't have the time to revise it always. So what we need to do, we will have to go through. We'll have to create a catchword. We'll have to create an acronym. Basis that acronym, if you remember that acronym quickly, you'll always there's an issue of starting. You'll not be able to start the answer. So therefore, you need to keep a catchword in your mind. You need to create certain catchwords for you to remember that, and at least out of these 13 points, you'll be able to write 6-7 points. You'll be able to get the marks, right? So you may not target to write all the 13 points, but at least 6 to 7 points. If you write, that is good enough for you to get decent marks, right? Now, coming back to overvalued assets. Overvalued assets, RIP. Now, the catchword here is RIPCLG. Anyway, the auditor shall have to specifically examine the following areas: uncollected or uncollectable receipt. That is basically bad debts, right? Obsolete, slow, non-moving inventories or inventories valued above NRV, huge inventories of packing materials, etc., with the name of the company, right? Underused or obsolete plant and machinery, and that's where the plant and machinery is there, but that is obsolete. Okay, you're not able to use that plant and machinery. It has to be written off. Assets carried at much more than the current market value due to capitalization of expenditure, foreign exchange fluctuation, or capitalization of expenditure, mainly in the nature of revenue. So there are assets, okay, which are very, very higher. The value of the assets in the books are very higher when compared to their actual value, because a lot of things that are capitalized, like capital expenditure, so many things that are capitalized which are unrequired, it may not be required as per the generally accepted accounting principles, but are still there, and therefore it's a very, very high, or they're just too high, considering the market rates. It could be that, right? Litigated assets and property, right? Investments carried at a cost to realizable value, though realizable value is very much lower. Yes, of course, investments carrying a very low rate of income or return. Last one, infructuous, that is fictitious project expenditure or deferred revenue expenditure. Group company balances and reconciliation, very important. Intangible assets of no value. So these are the overvalued assets. So basically, we're looking for an expectation of over. There are assets which are like very, very highly valued. Sir, why this is important? Because from a diligence standpoint, when you arrive at the valuation, when the buyer arrives at the valuation, he has to give importance to all the assets on the company. Now, if the assets are overvalued, then the purchase consideration also will be overvalued. That's what it means. Right. So these are the different overvalued assets. Yeah. The next question is, now let's go on to question number 2. The next question, right? Question number 2, Roshan. Now there are two parts. I mean, there are more than two subparts to this question. Okay. Roshan, a practicing chartered accountant, is appointed to conduct the peer review of another practicing unit. What areas Roshan should review in assessment of independence of the practicing unit? Okay, here the question is on independence. So what is the question, sir? The question is on peer review. The question is on peer review. So it is chapter number 17 of your CA final syllabus, peer review. Right. So the first part is, there is a person who is conducting a peer review. What are the things that he should consider while assessing the independence of that? Every auditor is required to be independent. Independence is a very, very important concept in auditing. Independence of mind and independence in appearance, right? If you're not independent, then you cannot be auditor. All your provisions under the Companies Act, Section 141, disqualification, qualification, all are aimed to ensure that the auditor is independent. That is why in the SS 700 report, the first title to the audit report is Independent Auditor's Report. If you're not independent, if you're not neutral, if you're unbiased, then if you're not that, then your opinion is of no value to the users of the financial statement. You have to be independent when you do your audit. So what are the things that needs to be considered while assessing the independence of the practicing unit? Sorry. Next, point number B. You are required to classify the following units into level 1 entity or level 2 entity for the purpose of peer review, along with providing the reasons for such classification, assuming the services have been undertaken in the period under review by such CA firm. So now this question can be attended only if you know the answer, only if you've studied this particular chapter. Otherwise, this question is impossible to write. Right? We'll come to this when I take this question number B. Part number C. Evaluating the professional judgment exercised by the auditor is one of the important aspects under quality review. So there are two aspects of this chapter, right? Peer review and quality review. The first two parts are peer review. The last part is quality review. Please explain the situation with reference to applicable essay. So here the question is on professional judgment with respect to applicable essay. So the moment it says professional judgment, applicable essay, and quality review, you have to understand it is from chapter number 7. Okay, now let's go one by one. Let's go with the let's go with question number 1. That is a part A. Roshan, a practicing chartered accountant, is appointed to conduct the peer review of another practicing unit. What areas Roshan should review in assessment of the independence of the practicing unit? Okay, now we are talking about independence here. Okay, so let's go to the answer directly. Review in the assessment of independence of the practicing unit. The reviewer, basically Roshan, okay, should carry out the compliance of 5 general controls. That is independence, maintenance of professional skills and standards, outside consultation, staff supervision and development and office administration, and evaluate the degree of reliance to be placed on them. The degree of reliance will ultimately affect the attestation service engagements to be reviewed. Right now, here this is a very general thing. 5 things have to be generally looked into by the peer reviewer. Right now, independence is the main quality expected of an auditor. That is the very basis for the existence of the profession of auditing, and that is auditing is fundamental quality of an auditor. Okay, fundamental quality of an auditor is independent. He has to be independent. If he's not independent, he cannot express his opinion. His opinion is of no value. Right? Independence is a condition of mind as well as personal character of a person. It is difficult but very easy to. It is difficult to define but very easy to perceive. Now, guidance note. Now you have to mention this guidance note on independence of auditor clarifies that independence independence is of two types, that is independence of mind and independence of appearance. Meaning what, sir? You have to be independent not only in mind, but also when you go to the auditors or when you go to the client's office, you need to appear to be independent. You cannot be one among the management. You have to appear to be independent as well. You cannot just or you cannot just appear to be independent. In mind also, you need to be very, very independent. So it's not only a concept of mind, it's also a concept of appearance. Both have to go hand in hand, right? The guidance note further states that there are certain threats to independence which are classified as self-interest threats, self-review threats, advocacy threats, familiarity threats, and intimidation threats. Very, very important. All these threats are very important. It is also discussed again in professional ethics as well. This is also your CA inter also you study about these threats: self-interest threats, self-review threats, advocacy, familiarity, and intimidation threats. If any questions on these 5, please let me know in the chat box, right? The responsibility of the peer review, therefore, is to ascertain the existence of the independence and the absence of threats to independence. So first, what is the responsibility of the peer review? The peer reviewer is responsible to check whether the auditor is independent and whether there are any threats to his independence. What are the threats? The 5 threats that we just spoke about: self-interest, self-review, advocacy, familiarity, and intimidation, right? Are there any threats to the independence? Okay, so if there are any threats to the independence, whether the auditor has placed adequate safeguards to mitigate the risk of those threats, right? So that is what has to be assessed as far as the independence of the auditor is concerned by the peer reviewer, right? Now, the reviewer should therefore check the following aspects in respect of assessment of independence of the practicing unit. Now, this is only the main answer. Does the practicing unit have a policy to ensure independence? So the first one is policy, whether there's any proper policy with respect to independence. Mr. Roshan, the chartered accountant, the practicing unit has to have, every CA firm will have to have a policy for independence. How it ensures independence of it, how the partners ensure the independence, how the team members or the firm ensure the independence on its own, right? Objectivity and integrity on the partners and staff. Who is responsible for this policy? Generally, the engagement partner will be held responsible, or the head of the senior most partner will be held responsible. Does the practice unit communicate these policies and expected standard of professional behavior to all the staff? So whether there's proper first, there should be a policy. Second, whether a communication is there or not. That is point number 2. Point number 3, does the practice unit monitor compliance? It's just not necessary to see whether there's a policy, whether you communicate the policy. It is also important to check whether all are complying to this policy of independence. So does the practicing unit monitor compliance with policies and procedures relating to independence? Basically, how, sir? We will have to, suppose when the company has to, the firm gets a new client. The moment the firm gets a new client, the audit client, the firm has to tell all the members of the firm that, boss, we have got this client. If you have any share in this client, immediately sell it off. And everyone has to sell it off. Okay, or you please let us know if you have any of your relatives or someone working in the client, okay, and in what position. So whether everyone is replying, whether this is being followed, this is the policy, okay, whether this is being followed, that has to be checked, right? Does the practice unit periodically review the practice unit's association with clients to ensure objectivity and independence? Then proper review is done with respect to independence or not. Okay, periodically review the practice unit's association with the clients to ensure objectivity and independence. How does the practice unit deal with threats to it? If there are any threats, what is the practice unit generally do? No, sir, nothing is being done. Then there is a problem with respect to independence of the auditor. So 5 points. Okay, first one, there is a policy. Second one, the policy has been communicated. Third one, there's a proper monitoring of the policy, monitoring the compliance with the policies and procedures. Fourth one, the policy is periodically reviewed. Okay, with respect to does the practice periodically review the practice in association with clients to ensure objectivity and independence. Fifth one, if there are any threats to the independence, what are those threats? The 5 threats that we discussed: self-review, self-interest, advocacy, familiarity, intimidation, right? So if there are any threats to the independence, how does the practice unit deal with the particular threats? That has to be also be checked, right? So these are the 5 questions, 5 important. This is the main answer, right? So any doubts with respect to this, or can I proceed to the next part? Can I proceed? Okay. I'm assuming there are no doubts, right? You are required to say question number B. You are required to classify the following practice units into level 1 entity or level 2 entity for the purpose of peer review, along with providing the reasons for such classification, assuming the services have been undertaken in the period under review by such firms, by such CA firms. Now, there are 5 questions which have been given. Now, what is this level 1 and level 2? Now, if you've gone through the chapter, you will know the meaning of level 1 and level 2. Basically, peer review does not happen for all audit engagements, right? Peer review happens only for selected audit engagements, right? Selected audit engagements. So whoever is the auditor, he's picked up. So it bases the engagement, audit engagements that you do. Now, they classify the audit engagements into 2, level 1 entities and level 2 entities. Okay. Now, if banks, mutual funds, all of them will come under level 1. Okay. The others will come under level 2. Okay. So there are certain classifications basis which it is classified to level 1 and level 2. Level 1 entities are those entities where the peer review process is more stricter. I mean, I would not say it's stricter. The frequency in which the audit is selected, the peer review is selected. I mean, the engagement is selected for peer review is higher, once in 3 years. Whereas level 2 entity, it's once in 4 years. Okay. Level 1 entity are more risky entities. Level 1 entities are entities which involve a lot of public interest, right? Like, I mean, share listed companies, then banks, then mutual fund companies, so on and so forth. It involves a lot of public interest. So that is classified generally in level 1. So if you have gone through the your peer review chapter, you will see there will be certain entities which are classified as level 1 and certain entities which are classified level 2. Now, only if you know that classification, you will be able to answer this question. Otherwise, it is not possible to answer this question at all. Okay, let's go on to the now. What are those entities and what is the information that is given? MT and company. Data of assurance service provided by such firm. Now, this is the main part is this. The main part is this data of assurance, right? Conducted statutory audit for private company, which is an associate of a company. The net worth of the company is 300 crores, right? That's the first one. Conducted statutory audit mutual, whether it's a level 1 entity or level 2 entity, that has to be told. And also we need to give clarity, justification as to why we are saying it's not to choose the correct answer, level 1 or level 2. You need to give a justification as to why it is the level 1 or why it is the level 2. That is what is important, right? GBL and company, conducted statutory audit for mutual fund company. IML and Associates, conducted statutory audit of a company registered under Section 8 of the Company Act 2013, but is not covered as a public interest company. However, it has raised a contribution of 60 crore rupees. Right. So that's the third one. The fourth point, conducted statutory audit of an unlisted public company having net worth of 4 crores and a turnover of 55 crores. The net worth of its parent company is 325 crores. Now, why these parameters are given? Because these will help us in classification of level 1 and between level 1 and level 2. If you don't know level 1 and level 2, this question cannot be answered, right? Again, I'm saying conducted statutory audit of LLP, which has raised a loan of 35 crores from a bank and a loan of 10 crores from an NBFC, respectively. Right. So these are the different five types of firms with different types of engagement that they have performed. Now, basis this information, we have to classify whether it's a level 1 entity or a level 2 entity. Now, MT and Co level 1. I'm sorry. MT and Co, it's a level 1 entity, right? Why? A practice unit, basically a chartered accountant firm, which is undertaken statutory audit of a company which is an associate of an entity having net worth of more than 250 crores at any time during the period under review shall be treated as a level 1 entity. So that's a justification, right? GBL Co mutual fund company is generally covered as a level 1 entity. So that is the answer for the second point. The third point, a practice unit which is undertaken statutory audit of an entity which has raised donations and or contributions over 50 crores during the period under review shall be treated as a level 1 entity. So I have raised 60 crores of money. That's what is given, right? 60 crores. Therefore, it becomes a level 1 entity. Next one, conducted statutory audit of an unlisted public company having a net worth of 4 crores. A practice unit which is undertaken statutory out of a company which is a subsidiary of an entity having net worth of more than 250 crores at any time during the period under review shall be treated as level 1 entity. So if you look at this particular thing, it says the parent company is having a net worth of 325 crores. So more than 250 crores net worth, if it is more than 250 crores, then it is a level 1 entity. The next one is on the LLP part. Now, only the LLP part is a level 2 entity, a practice unit which is undertaken statutory audit of an entity which has raised funds from publics or banks or financial institution of more than 25 crores but not less than 50 crores during the period of review shall be treated as a level 2 entity. So here it has raised money for 30 crores, 20 crores from bank and 10 crores from NBFC, sorry, 35 crores from bank and 10 crores from NBFC. So it is 45 crores. So between 25 and 50, it is level 2 entity. So this is how you need to write. So this bifurcation you will know only when you have gone through the classification between level 1 and level 2 entity. Right? Now going on to the third part of this particular question, A is answer, B is answer. Now going on to C. Evaluating the professional judgment exercised by the auditor is one of the important aspects under quality review. Please explain the situation with respect to applicable standards on auditing. Now this is very, very important. Why this is important? Because here it talks about professional judgment. Here it talks about professional judgment. Now, the moment you hear of the word professional judgment and it talks about explain the situation with respect to the applicable assay or with reference to the applicable. The moment professional judgment comes into play, okay, or professional skepticism comes into play, the standard on auditing which is applicable is SA 200. What is the name of the standard? Overall objectives of an independent auditor and conduct of an audit in accordance with the standards on auditing. Right. So this is the standard that is applicable for for professional judgment. But we don't have to just explain the SA 200. We have to explain in reference to or in considering the context of quality review, because that is what is important. Audit is one of the important aspects. Evaluating the professional judgment exercised by the auditor is one of the important aspects under quality review. So therefore, we need to give it under the context of quality review. Okay, we have to prepare or we have to explain the answer keeping the context of quality review in mind. Also, we need to give a reference to the standards on auditing, which is basically SA 200 in this case. Okay, now going on to the answer. Right, it is also important for the technical reviewer. Okay, TR. So the person who does quality review is called the technical reviewer. Right, the ICAI has a board called Quality Review Group. Okay, the people who form part of this quality review group are called technical reviewers. To understand that professional judgment as defined in SA 200, overall objectives of an independent auditor, and you have to name the standard. The name of the standard is more important than the standard itself. Right? SA 200, overall objectives of an independent auditor and conduct of the audit in accordance with the standards of auditing is an integral concept in the context of an audit and application of SAs in real life audit scenarios. Now, what is the meaning of professional judgment? Professional judgment means, the definition is professional application of TEK. What is TEK? Training, knowledge, and experience. You have to apply your training, whatever you have been trained, knowledge, whatever you've been studying, and your experience. Okay, within the context provided by auditing, accounting, and ethical standards in making informed decisions about the course of action that is appropriate in the circumstances of the audit engagement. Okay, so you have to apply your TEK. What is TEK? Training, education, and knowledge. Training, knowledge, and experience. Training, knowledge, and experience within the context of the standards, that is auditing, accounting, and other ethical standards. Ethical standard means your professional ethics, right? Auditing, accounting, and ethical standards in making informed decisions. About the course of action that is appropriate in the circumstances of the audit engagement. As I told you, audit is a very subjective concept, okay, because we are ultimately giving an opinion. Opinions will not be the same. My opinion will be different from your opinion. The way I look at things will be different from the way you look at things. Okay, the perspectives are different. Therefore, we need to understand that the process of audit involves a lot of professional judgment. A lot of calls will have to be taken by the auditor when he does audit. Okay, now these calls have to be well informed, and these calls have to be within the context of the standards. Okay, and also applying the knowledge, training, and experience that you have gained over the period in making informed decisions during the course of audit engagement. That is what is the meaning of professional judgment, right? So any decisions or any conclusions that you arrive, we will have to take into account how much of professional judgment has been exercised by the auditor. Any conclusion that is arrived by the auditor while completing his audit, we need to understand how much of professional judgment is arrived. You cannot just like that take a stand or randomly, choose yes or no or do inky pinky ponky. It doesn't work like that, right? It has to be based on certain professional judgment, certain application, certain training, certain logic will be there while taking a professional judgment. Because not everything is not straightforward, right? The concept of professional judgment underscores the fact that standards, particularly standards in auditing, are written to lay down the fundamental principles that apply to an audit situation. Hence, no standard can have a straight-jacketed application. Yes, absolutely. Above all, standards on auditing issued by ICAI are principle-based rather than rule-based. They are principle-based standard, not rule-based standard. Hence, almost all the SAs envisage exercise of professional judgment by the auditor in their application in real-life audit scenarios. It's not like this. It's not like a company that where this is what needs to be done. Within 30 days, the form needs to be filed. Within 15 days, this has to be done. It is not rule-based. It is very, very principle-based. All standards are this may be done, this can be done, this is the purpose, this is the objective. That is how all the standards are formulated. The TR would need to appreciate that the exercise of professional judgment in any particular case is based on the facts and circumstances that are known to the auditor at the time of exercising that professional judgment. Normally, exercise of professional judgment by an auditor is preceded by consultation on relevant matters, both within the engagement team and between the engagement team and others at the appropriate level within or outside the firm. So basically, when taking a call, okay, you need to see how much consultation has been done. Okay, if you don't have the relevant expertise, the engagement partner, he will consult with people outside the firm, will consult with people in the firm which are at a more senior level, so on and so forth. So an informed decision after consultation is a very, very good professional. Then if consultation is there, then the professional judgment will be very, very good, because a lot of consultation is gone to take that professional judgment, right? In evaluating the professional judgment exercised by the auditor, the TR, basically the technical reviewer, should consider the following factors. Now, this is the main answer. Whether judgment reached reflects a due consideration and application of the relevant auditing and accounting principles. So whether technical standards have been complied with or not. Relevant auditing and accounting principles. That is point number one. Whether judgment is appropriate in the light of and consistent with the facts and circumstances that were known to the auditor up to the date of the audit report. So they are in line with the facts known to the auditor up to the date of audit report. Hence, the TR and the QR team should not, under any circumstance, use hindsight in their evaluation of professional judgment by the auditor. So basically, the auditor will know certain facts at one point in time. After the audit report, the facts may have changed. Okay, the facts may have changed, the conditions may have changed, the circumstances may have changed. So the technical reviewer should take note of what are the facts that were known to the auditor at the time of audit report, basis which the professional judgment was taken. That is what is important, right? Since the auditor needs to exercise professional judgment throughout the audit, the latter also needs to be appropriately documented. Why this conclusion that we discussed earlier in SA 230, when the conclusion is made, okay, why that conclusion was made, what is the rationale for the conclusion, all that has to be documented appropriately. Hence, the TR can expect to find such audit documentation as a part of the audit engagement file. It is important to note that the professional judgment cannot be used by an auditor as a justification for decisions that are not otherwise supported by facts and circumstances of the engagement or sufficient appropriate audit evidence. Okay, so any professional judgment should be basis the facts and circumstances of the case. So this is the answer with respect to quality control, with respect to professional judgment in quality to be exercised in the context of quality review. Okay, after giving application, after giving due reference to the standard, which is SA 200, and also we talked about SA 230 with respect to audit documentation, right? So this is the answer, right? So these are three parts to this answer. Part number A, peer review. Part number B, entity level 1 entity, level 2 entity, with this again peer review. And part number C is basically your now this is a very important question. Question number 3. This is absolutely from your professional ethics. Okay. So it is very advisable that you go through a lot of, I mean, after reading your chapter, you have to read this chapter like multiple times for you to, consolidate this chapter in your mind. Point number 1. Once you read the chapter, please go through. There are plethora of questions in your RTP, in your mock test papers, in your ISM, in your study material also. Please go through as much questions. I mean, even in your past examination questions, please go through as much as questions. Okay, as many questions as possible. Okay, as many, again I'm repeating, as many questions as possible with respect to this chapter. The more questions you go through, the more confidence you will get. So as far as this particular chapter is concerned, it is always advisable to go through, because all the questions are case study type. You will not get any straightforward question in the examination, right? Everything will be case study, something similar to what we are going to discuss. So you please go through as many questions as possible for you to get a confidence or a grip over this particular chapter, right? Now, let's discuss this question number 3, right? The director discipline of ICAI received information of alleged misconduct against Mr. Jayaprakash, the proprietor of JP and Associates, as follows. Okay, now we are reading the question, then we'll give the answer. Audit of a college was accepted by JP and Associates, in which Mr. Jayaprakash is working as a part-time lecturer, and also he had not taken permission of the ICAI for working as a part-time lecturer in the college. That's the first alleged misconduct. Second one, an event relating to CSR, corporate social responsibility, was sponsored by JP and Associates. That's the firm in which he is the proprietor, whereby in the sponsorship banner, name of Mr. Jayaprakash as CA Jayaprakash, proprietor JP and Associate was mentioned. So not only CA Jayaprakash, but that he is the proprietor of JP and Associate has been mentioned. So whether this is a misconduct, right? On the basis of the above information, along with certain evidence against Mr. Jayaprakash, he was found guilty, and so he was reprimanded, and a fine of ₹1 lakh was imposed by an order against him dated 12th of July 2020. Against the said order, Mr. Jayaprakash preferred an appeal with the appellate authority on 17th August 2020 by submitting a statement of appeal along with the application form of appeal. So he gave an appeal to the ICAI, right, to the council, to the appellate authority. During the appellate proceedings, it was discovered that the said statement of appeal contained some facts which were false, to which Mr. Jayaprakash admitted it to be false and apologized for it. Okay, the statement of appeal, there were facts which were not true, which were incorrect, right? Now, what is the question? Now you have to answer the following 2 questions. Whether Mr. Jayaprakash has violated the provisions of the Chartered Accountants Act of 1949. That is basis the facts that are given, 1, 2, and also this part, right? Question number 2 is, before which authority the matter of Mr. Jayaprakash would have been placed, and what maximum punishment would have been imposed on him by the said authority in accordance with the Chartered Accountants Act of 1949. So, boss, this is the question. Before which authority the matter of Jayaprakash would have been placed, and what is maximum punishment would have been imposed by him on the said authority in accordance with the CA Act of 1949. So it is not only a question on what is a misconduct, it is also a question on depending upon what misconducts we are saying, because there are first schedule misconduct and second schedule misconduct. Now, depending upon what kind of misconduct it is, it will be the matter will be placed on at certain authority. If it's a first schedule, then it will be placed on a certain authority. If it's a second schedule, then it will be placed on certain authority, before certain authority, right? So we'll have to even know the disciplinary proceedings, okay, to answer this particular question. Okay, so now let's go on to the answer. Mr. Jayaprakash has violated the following. Now, first, have to go one by one. When you write, you'll have to first, now, it's professional ethics questions. Okay, when you write the question, okay, you will have to definitely mention the clause number, the part number, and the schedule. The clause number, the part number, and the schedule. Without that, you cannot write the answer, for which you need to memorize the clause number, the part number, and the schedule. And the offense, the alleged misconduct, also has to be mentioned, okay, as is, which is given in the study material. You cannot write your, it's like your, your Tirukural or your Doha, or what you want to call it. You have to write as is, verbatim. You have to maybe practice the writing. Okay, you cannot write it on your own. This is something which you cannot write. The verbatim misconduct has to be written. Okay, you cannot write it on your own, and then you'll have to explain that misconduct, and you have to link that misconduct with the facts of the case. Okay, in the first scenario, audit of a college was accepted by JP and Associate, in which he is a part-time lecturer, and also that he has not obtained any permission from ICA. Now, there are two misconducts which are there. Okay, the first one, as per clause 4, as I told you, you'll have to mention the the clause number, the part number, and the schedule. As per clause 4 of part 1 of second schedule to the Chartered Accountants Act of 1949, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he expresses opinion on the financial statement of any business or express in which or enterprise in which he, his firm, or a partner in his firm has a substantial interest. So in this case, he is a lecturer also. That means he is also having a substantial interest. In this correction, as per the decision of Council of ICAI, chartered accountant should not by himself or in his firm name accept the order of a college if he is working as a part-time lecturer in the college. So this is the, so if you look at the clause, they have given the clause number and the verbatim explain the clause first. Okay, a chartered accountant, this is the verbatim clause which is the misconduct. Then they explain the link the facts of the case with the clause. So you'll have to write the clause number, the part number, and the schedule, and you have to explain that by giving the verbatim the way it is in the book. You cannot write it on your own. That's very, very important, right? Next one. Thus, by accepting the audit of a college in which he is working as a part-time lecturer, Mr. Jayaprakash has violated the restrictions imposed under clause 4 of part 1 of second schedule to the Chartered Accountants Act of 1949. Now, the next part. As per clause 11 of part 1 of first schedule to the Chartered Accountants Act of 1949, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he engages in any business or occupation other than the profession of chartered accountant, unless permitted by the council so to engage. So basically, he's also working as a part-time lecturer, but he's not obtained any business occupation. He's not obtained any permission from ICI to do so. So in this case, members of the institute in practice may engage in part-time or full-time tutorship under any education institution other than the coaching organization of the institute after obtaining the specific and prior approval of the council in each case. In this case, no permission was obtained, and therefore he is guilty of professional misconduct. Okay. Mr. Jayaprakash had not taken any permission of ICI for working as a part-time lecturer in the college, and so violated the restrictions imposed under clause 1 of clause 11 of part 1 of first schedule to the Chartered Accountants Act of 1949. So there is one offense under second schedule, there is one offense under first schedule. Now, the second case study which was given, which was with respect to event in CSR, his name was there and he was shown as the proprietor, right? Now, an event, as per clause 6 of part, this is on soliciting, right? Clause 6 of part 1 of first schedule to the Chartered Accountants Act of 1949, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he solicits clients of professional work, either directly or indirectly by circular, advertisement, personal communication, or interview, or by any other means. Right? So this is the verbatim clause which is given in the study material. In this connection, members sponsoring activities relating to CSR may mention their individual names with prefix CA. That is there. However, mentioning a firm's name or CA logo is not permitted. We can say CA Jayaprakash, but here what is there? CA Jayaprakash, proprietor Jayaprakash and Associate. So that is incorrect. You can mention your name with the prefix CA, but you cannot mention proprietor, etc. That is against the Chartered Accountants Act. So an event relating to CSR was sponsored by JP. So first you have to mention the technical literature, then you have to mention the facts of the case, and then you have to give your conclusion. That's how we kind of write this. So that's the way the answers are presented. Right? was sponsored by JP and Associates, whereby in the sponsorship banner, name of Mr. Jayaprakash as CA Jayaprakash, proprietor, JP and Associate was mentioned. Thus, the firm's name was mentioned, which is not allowed, and thus Mr. Jayaprakash has violated the restrictions imposed under Clause 6 of Part 1 of first schedule to the Chartered Accountants Act. The final conclusion is whether there is a misconduct. If yes, then he has violated. So everywhere the conclusion will be violated. Then here you see is violated. Okay, so you'll have to mention that that's the conclusion, that he is violated, he is violated, he is violated. That's the conclusion that we'll have to mention all the time, right? Next one. As per Clause 3 of Part 2 of second schedule to the Chartered Accountants Act. Now this is on when he gave a statement of appeal, and the statement of appeal was incorrect. Okay, the facts were incorrect, right? A member of the ICAI shall be deemed guilty of professional misconduct if he includes any information, statement, return, or form to be submitted to institute, council, or any of its committees, director, discipline, board of discipline, disciplinary committee, quality review board, or the appellate authority, any particulars knowing them to be false. So here, in case he gave a statement of appeal, the facts of which were incorrect, and he knew to be incorrect, and therefore he is guilty of professional misconduct. Mr. Jayaprakash, in the statement of appeal submitted with the appellate authority, mentioned some facts knowing them to be true, false, and thus he has violated the restrictions imposed under Clause 3 of Part 2 of second schedule to the Chartered Accountants Act of 1949. So how many violations? There are 4 violations. There are 4 violations which are there. Clause 4 Part 1 second schedule, Clause 11 Part 1 first schedule, Clause 6 Part 1 first schedule, and Clause 3 Part 2 second schedule. Clause 3 Part 2 second schedule. So all these are violations. All these are the 4 violations. If you answer these 4 violations, you will get full marks in the examination. If any of 1 or 2 is missed out, accordingly marks will be cancelled. So violations will have to be given in 3. First, you'll have to mention the facts of the case. You have to mention the violation itself, which is verbatim the way the technical literature that you are giving, that comes from the study material. You have to mention the clause number, the part number, and the schedule to the chartered accountant, and you say a practicing chartered accountant will be guilty of professional misconduct if he does the following. So that has to be verbatim mentioned. So you need to practice that, you need to memorize it, and then you have to mention the facts of the case, and then you have to give a conclusion. And facts of the case saying that this guy has done this was done, and therefore he is guilty of professional misconduct. He has violated the restrictions imposed under so and so clause. So that's how you need to write the answer. Clear? Literature, facts, conclusion. That's all. That's how you present any case study. Now the second part of this question is that whether before which authority the matter of Mr. Jayaprakash have to be placed basis the violations, and what is the maximum punishment that can be imposed on him in accordance with the C Act of 1949. Here for that the answer is, since he has violated both first schedule and second schedule, as Mr. Jayaprakash has been alleged of misconduct falling in first schedule as well as second schedule, the matter would be placed before the disciplinary committee. If it's only first schedule, then it is not disciplinary committee. If it is both the schedule, then it is a disciplinary committee. The maximum punishment which could have been imposed on him by the said authority would be reprimanding the member, removing the name of the member permanently or for any duration which it thinks fit, and imposing a fine up to rupees 5 lakh. So this is the maximum penalty. So you cannot only know the violations, you will have to also know under which authority it would be placed. So it's a very comprehensive answer, very comprehensive question. Okay, very beautiful question selected by Veranda CA. It's a very nice way to put it. So as I said, go through more and more questions.